first, for our people that don't live here, take a little bit of time to let you know what our metro area looks like. We have two states. We have Kansas and we have Missouri. And the whole entire metro covers both states. There's about 5 counties in our metro. And 2 of the largest cities in our area are going to be Kansas City, Missouri, and Overland Park, Kansas. Kansas City, Missouri is in Clay, Platte a little bit, and Jackson. Covers quite a range of area. And then if you look at Overland Park, it is all in Johnson County. And the other, for those of you that don't know, the other Kansas City is in Kansas, and it is in Wyandotte County. And those 2, city and county, have combined their government, and they are called the unified government. So it is very local across Kansas City. Every area is a little bit different, and I'm going to be taking a look at the broad overview. So I'm going to invite you to, when I give you my resources for where my data is coming from, go there and you can dig into the little more localized areas so you can know your specifics of a specific city or a specific county. So we're going to look at the broad general overview. So where does the data come from? And it comes from Kansas City Regional Association of Realtors. If you go to their website, KCRAR.com, at the very bottom area, there's several icons, and one of them is statistics, or you can just do /statistics. You'll get there either way. And they have quite a few years, but they've got the most recent, which is what we're going to look at. And they have it in a flipped order. I'm going to start at the end and work backwards because it makes more sense for me that way. And my presentation makes a little bit more sense. So we are going to start with inventory. And that's what everybody in Kansas City has been talking about since probably about 2013, 2014. Where's the inventory? Where is the inventory? Where is the inventory? It's steadily declining. And what happened? Well, inventory, as you know, peaked during the last recession. This is right here. This is 2008. This is 2009. And this is 2010. And we pretty much worked our way through. We had a little bit more glut, and then we started coming down. So right then, those banks were foreclosing right and left on anybody and everybody. Lenders were not lending to investors, the traditional lenders. You couldn't get a bank loan to buy and hold. You couldn't get a portfolio loan for a package of houses. It was tough to find hard money. A home equity line of credit did not exist. And if you were to get a loan, it was quite costly. So the magic formula back then for everybody to buy a house, you know, right now the formula that everybody teaches is 70% of ARV. Well, back then that didn't work. We were more like 60 to 65% of ARV. And as we've been trending downward, that number's been going up. So in the past, probably since 2016, we've been seeing investors pay up to 80% of ARV as the inventory has declined, just because that's the only way to get a deal. The profit margins have gotten lower and lower, but inventory is still trending down. If you look from May of 2019 and look at those numbers all the way through the past year on resales, they are still down. The blue line here, those are new homes, and we're not really going to touch much on new homes. Although you're going to find that the new home numbers went down. And why did they go down? Well, 1, nobody was buying them, and 2, nobody was lending to the builders to build new houses. And we kind of bottomed right in here, and it's been coming up a little bit, but I really don't think we're going to see the new home builds like we were back in 2007 and 2008, because the builders, well, you know what? Inventory went down on resales because the builders are all buying the resales as well. So not only do we have all the normal investors, we have DIY buyers, and we also have the builders and hedge funds that have been buying up houses. So that's where all of our inventory has gone. Now let's move on to supply. And supply, I look at it kind of like this. If we were to look at all the houses on the market this month, how long would it take for them to get sold? They define it as the inventory of homes for sale at the end of any given month, and then they divide that by the average monthly closed sales for the last 12 months. But how long would it take for us to run out? And they also, if you go look at all the experts, an average level supply, it doesn't favor the buyer, it doesn't favor the seller. Average market even supply is between 4 and 6%. So right here during the recession, we were well over 6%. It was a buyer's market. There was lots of houses, they were cheap. If you had the money, you could buy a house. Now, you might have all the money in the world, but the supply is really low and choices are limited. And it has been continuing to trend downward since, when was that? 2011. And it's continually gone downward. We do have a little bit of blip because right here in the middle is the winter holidays, and where it peaks is the summer holidays. So that kind of gives you a look at our supply here in Kansas City. Closed sales, transactions that have actually closed. And if you look, and this is what I think is very interesting. Everybody's like, oh, when the Great Recession happened, the economy and the houses, it was awful. But here in Kansas City, here's the recession right here in the middle. If you can see my mouse swirling around there, it went down, yes, but did it go down a lot? No, it didn't. And right now, we're a little bit above the high. So we are at our highs in 2016, 17, but we're staying put. We haven't, we're on our normal market rise, and we're going up to our peak in the summer. And so closed sales really haven't changed much. I can't say, I know we had a little blip, and we'll look at that in another chart on down. We had a little blip in the past 30 to 45 days, but we recovered because this number really should be just a little bit higher, but we did have a blip. So we'll look at that. Next thing I want to take a look at is average sale price. And this is going to be more important for you to go back to that data section that I told you to go to and dive into the area where you look, because you want to know what average sale price and median sale prices. And those that price, and that's pretty much across the country, average and median sale price. That's your bread and butter house. That's the house that first-time home buyers are buying. That's the house that the investors are buying for rentals. So it can go either way. So you have the most number of buyers for the average price house, the median price house. I know average and median are not the same terms, but the numbers are very similar, at least here in Kansas City. But if you look at resale, average prices went down a little bit, but we've been trending upward. And even between December and now, the numbers have steadily gone up. And if we look at median, I can get my thing to flip over, again, steadily went up. But the average sale price is $238. And that's if you average all the sale prices together, that's the average price. The median price is if you look at all the prices, the median price, the most middle price would be the $215. That really, we've held steady. We've been increasing, but not a great increase. And even in 2008 and 9, not a great decrease either. So that's really important to know for Kansas City. We're kind of boring here in Kansas City. Nothing really changes a lot here. That's because we have so many different industries. We're not dependent on just cars, and we're not dependent just on Silicon Valley, and we're not dependent just on an airplane manufacturer. We have a lot. We don't have airplane manufacturer in Kansas City, but we do in Wichita, so we do get people through here. We have a lot of different industries. So let's move on. How long is it taking our houses to sell? And again, we have the seasonal ups and downs. But as you look, days on market, it's been steadily going down since 2011. And it hasn't changed. Houses are selling even faster in this past month. And I think part of the reason for a house selling that quickly in this past month was there were so few houses on the market that if you had a house for sale, the buyers out there were motivated and they were snapping up everything they could get, as long as it was priced right to begin with. So the next thing is percentage of original list price. How close to your listing price are you getting? And I would say that in a perfect world, if people had priced their houses exactly perfect, well, yeah, in hindsight, exactly perfect, we'd all get 100% every time. But we haven't been seeing, and if you look at this, so you can see this number, this line right here, that is 95%, and this is 100%. New home builders are getting over list price, and that's partly because they have upgrades. So they're like, this is our list price, but if you want all those extra stuff, it costs more. But used houses, resale houses, we have been getting over 95% since 2015, and in the month of April, they were pretty darn close to 100%, the closest we've gotten to 100% since last May. So let's keep going. Pending sales. We take a look at this. Pending sales have pretty much stayed on trend. Okay, and I had one more chart I wanted to look at. Let's go back to percentage of original list price. I wanted to point this out to you. If you look right here and think back to charts, or even look at all the charts that I've shown you. If we go here, they trend. They trend. But this chart is trending down. It didn't bottom out and then start trending up. No, it blipped up and then went back down and then started trending up. And I want you to look at that and think about that for a minute. Those of you that were in the housing market back then, in the industry, you will remember that in 2009, we had a stimulus package just like we have now. This stimulus package in 2009 said, well, I guess we got checks back then too. I don't remember. I think we got like $600. But in 2009, they had, because the housing market was collapsing, they were trying to get people to buy houses. So to incentivize people to buy houses, they said, okay, we'll give you an $8,000 tax credit. And that caused people to offer about $8,000 more than the market said they would normally pay, because they were going to get it back on their taxes. And I remember in 2011, probably from like right in here, mid 2010 through 2012, when I was looking at comps going backwards, I would always adjust them down by $8,000 because here there was no tax credit. So we had to weather the storm, let the tax credit work its way through the system, and then we went back to normal prices and started trending back upward. And the reason why I'm pointing that out is right now we're in stimulus. So in my house, for example, we got $1,200 for each person. In other households, that might be, I'm sure it was $1,200 for each adult person, but there might be more than 2 people in their household. So I'm wondering if that was going to affect housing prices at all. If people, that didn't really need the money, that they, they kept their job, they were still working, and all of a sudden they had a household of 4, perhaps, and they got $6,000 or something, if they might go use that to buy a bigger house, and they might pay a little bit more. Who knows? We'll wait and see what happens. Okay, so let's move forward to my very last chart. I saw this today on a workshop I attended, or at the WinVestor's meeting. I attended the WinVestor's meeting on Zoom, and this is Michelle Winberry's chart. She's been charting sales for the past, since the 8th, since we started noticing the pandemic through this week. She's looked at weekly numbers and she's looked at monthly numbers. And I think it's interesting if you take a look, new listings, and you got to think, everybody right in here is thinking, oh, it's spring, we got to get our house listed. This is prime time. We want our house on the market for when the spring home show happens. A lot of people list then. So we had 1,000 new listings. And then the next week, we only had 880, and then 860, and then we jumped back up. This is right when we all started staying home, so people stopped listing houses. Then we look at pending, and you would think it would trend upward, right? Just like the charts, but we had a blip, and that is, in this week, that's when they said, no basketball championship, everybody stay home, and then they had the big run on toilet paper, if you remember. Nobody did anything for about 2 weeks, and I think a lot of people didn't list their house during this time, so the houses just weren't there to buy. A lot of people were not out buying, and a lot of people pulled their houses off the market because they didn't want people in their houses. So that caused all the pending sales to back off. And then as we figured out how to do virtual home sales, the sales started trending back up. Then we have showing for backups, which basically is the same as pending. We're just not 100% sure that the buyer's fully going to close, so we put showing for backups. So somebody else might come look at it as well. And then we look at solds, and we're at 963, and we would have thought this would have trended upwards, because if you look back at all my charts, it trends upward. But again, it dropped back down to 712, but then it started coming right back up, because we had a week there where we froze. We didn't know what to do, and then they're like, we can only have one person come into closing. We can do a drive-by closing, and people can sign documents in their car. And as they figured out how to do closings, those numbers came back up. We did come back off a little bit this week. And I'm not sure why. I'm thinking that this 991 right here is an anomaly. And I think this 991 is all the deals that didn't happen here got bumped up to here. And I think that's where that came from. And then back on the market, houses that were under contract that didn't sell, they relisted them. And I'm going to say it might also include houses that were taken off the market temporarily and then put back on the market as well. So, you know, they had it listed, they took it off the market, and we didn't track that number, but they took it off the market because they didn't want people in their houses, and then they started relisting them. So we were here, it went down, and then back on the market. And I think that's where all the houses that had came off the market because the sellers didn't want people in their houses, they came back on right when we started going out and about. And then if you look at the daily, that's just dividing these numbers out into daily numbers. So that's in a nutshell, but I wanted to give you some other things to take a look at, to think about. So when we're looking at, well, what are we looking at? Sale prices of houses. Back in the day, so, well, anytime, if you go to any guru training class, I'm going to buy a house. What's the magic formula to buy a house? And they're going to tell you you're going to pay 70% of after repaired value. Well, during the economic problems of the last downturn, that number went down to like 60 to 65%. So if a house all fixed up was worth $100,000, you only wanted to put $60,000 in it to buy it and acquire it and then fix it up. As the sales prices have been going up and as the inventory has been going down, investors have been raising that 70%. You know, here was probably about 70%, but in this last few years, they've been paying 80 and 85%. So the profit margins for the people that are buying to flip have gone down greatly. But right now, everybody is advising, and I'm advising too, to be cautious and maybe go back to that 70% and try really hard to get down to 65. And here's why. I'm not thinking that, you know, that this number, I don't think that our sales are going to drop off. I don't think our values of houses are going to drop off. But what I'm thinking is, especially for those of us that sell to other investors. So say you wholesale houses to investors that are going to rehab, or you wholesale houses to landlords, or you sell to first-time homebuyers. Well, the lenders have changed some rules. So if you're selling to first-time homebuyers, there's a few fewer first-time homebuyers out there. Some that have been affected because they've lost their jobs or been furloughed, but some because the lenders have all of a sudden said, well, you have to have a higher credit score and you might need more money down. And then for those of us that sell to investors, just like back in the day of the last recession, the banks stopped lending to investors, and they haven't stopped lending to investors now, but they've backed off. And here's what we've seen in the past 45 days. I had a closing tank at the closing table because the lender didn't wire the funds. The hard money lender said, nope, not lending money anymore. I've also seen other hard money lenders said, you know, I'll still lend money, but now instead of me lending 100% of purchase price and 100% of the rehab, I want the investor to have 20% of their skin in the game, or 30% or more. Or they might have said, you know, you've been using this home equity line of credit and you had an $80,000 line of credit, but we think houses might go down. So banks might have said, you know, instead of 80,000, we're only going to lend you 50 now. And I've also heard of investors that use the commercial credit cards that had, you know, $10,000 limits. All of a sudden their limits were pulled back. So the money that the average real estate investor has access to has gotten a little bit tighter and a little bit harder to acquire, or a little bit more costly. So you need to take that into effect when you're selling to investors. There might just be fewer buyers out there. The people that are still buying still have some of their own money to put in the game, so they can, you know, put the down payments that the lenders are wanting. They also have their own money to buy deals. They've been hoarding cash for this opportunity because they have been telling us to do that for the last 3 years. And they've also been developing private money lenders so that when the opportunity hits, which everybody says it has, they can keep doing deals and not have to worry about the banks and the hard money lenders and the credit card companies holding back on money. The other thing we talked about at WinVestors this morning, which is really important also, is as you're working your comps, is this a good deal to buy? Think about this. We're trying to be very conservative on our numbers. Yes, Kansas City slow and steady wins the race, and they've been going up, but they're not going to go up quite as fast as they were. I would be very cautious about higher end houses and the really lower end houses. I would stick to the bread and butter houses that owner occupants can buy and landlords can buy. And the other thing that's really going to affect your deal is the cost of your rehab. And there's several things going on your cost of your rehab. The one thing that I've really noticed in our deals in the last 45 days, and actually the last 3 years, I need a contractor to do X, Y, Z. There's a lot fewer contractors out there. And it's gotten even worse in the last 45 days. Whenever I would plan to, you know, I've got a house, I'm going to close on it Thursday. I want my contractors to start next week. Well, the contractors are like, nope, I'm 3 weeks out. The really good contractors, they are busier now than they've ever been. And why? Well, a lot of homeowners got their stimulus checks and they're doing stuff to their houses that they probably wouldn't have necessarily done. 2, the mediocre, or I'm going to say mediocre, the smart guys, the smart contractors are like, they sat down with their CPAs and the CPA says, you know, you would make more money collecting the unemployment from all the stimulus package than you would from working. So I would advise you to shut your business down and collect unemployment for 6 months. So some of them went on vacation. The other thing that's been affecting having contractors, and this has been going on for 10, 20 years, as the contractors get older, they retire, and there's not new contractors coming on. There's a few, but the average, it's let's go to college and become an entrepreneur, or let's become a real estate investor. They don't want to be a contractor. I look at some of the contractors that have came through Mary. They don't want to be contractors anymore. They're buying and rehabbing houses, and they're making better money doing their own deals than working for other people. So we've lost some that way. But just through people retiring, and I'm thinking in the last 45 days that some of those contractors that were right on the verge of retirement said, you know, let's take Social Security and just be done with it. So that's another thing that's affecting. And then I've also been seeing in my rehabs, you know, so you got to put into your timeline longer time periods to get in rehab because it's going to take longer to get your contractors in there. Supplies, I've seen everything, and that, you know, toilet paper, meat, drywall. A person was on the WinVestors meeting this morning, and he's like, yeah, the price of concrete increased like 5 to 7% in January, and it increased in the last 45 days, another 5 to 7%. And that's across the board. All supplies for building houses have gone up. So where I used to say, oh, that's $1,000 repair bid, it's more. I mean, we just got a bid for garage doors on my house, and back, 10 years ago when I was running comps, new garage doors, oh, that would cost, $1,000 would give me 2 new garage doors. Well, not so much anymore. We got a $1,600 bid and we're not getting fancy garage doors. So that's going to affect. The other thing you need to worry about is closing times. Is it going to take longer for your buyers to close? Because right now, the lenders that are working are very, very busy because the interest rates are slow. They're refinancing everything under the sun because everybody's trying to get their houses refinanced before values plummet. I don't think the values are going to plummet, but that's what they think. That's what the lenders are telling them. Get them refinanced before the values go down. So is it going to take longer for your buyers to close? So factor that in when you're looking. So you're going to be more cautious on your comps. You're going to factor in longer hold times for rehabs. You're going to increase your rehab bids a little bit because it's going to cost more. And you're going to think about if you're selling to an investor buyer, is it going to, are there going to be as many as there were because there's less access to money. So those are some things to think about. And if we're going to talk about private money, if you're watching this before May 16th of 2020, we do have a workshop on private money at Mary that you might want to check out. It's Saturday from 9 to 1, and it's virtual, so you can attend it from anywhere, and it's very low cost, so check out the website there, mary.org, marei.org. I think that is all I have, and